Welcome to this explainer. Okay, we have got an incredibly fascinating and honestly kind of dangerous topic to dive into today. We're going to explore the mechanics of market chaos. More specifically, we're looking at the super complex relationship between market volatility and financial leverage. Look, whether you're trading traditional currencies or navigating the wild west of digital assets, understanding how these two forces interact is quite literally what separates the pros from everyone else, so let's get into it.
Here's our roadmap for today. We're going to start by comparing Forex and crypto. Then we'll unpack volatility clusters and look at how experts actually predict market chaos. After that, we'll shift over to the power of leverage, compare how leverage works in those two markets, and finally, wrap up with how you can actually manage your trading risk.
Section 1. Forex versus crypto. Let's set the stage by looking at the two distinct financial arenas we're analyzing today, because their structural differences completely change the game when it comes to risk.
Check out this staggering number, 3.2 trillion US dollars. That is the estimated daily transaction volume of the traditional Forex market. It's massive. It is without a doubt the largest financial market in the world. It evolved from a pretty rigid, limited-hour system used mostly by central banks into this massive, highly liquid, modern market mechanism we see today.
Now, the contrast between Forex and crypto is practically night and day. On one side, you have centralized Forex. This is electronic money heavily governed by traditional banking systems, strict regulations, and tight institutional oversight. But on the flip side, you've got cryptocurrency. We're talking about a decentralized, distributed ledger system powered entirely by blockchain tech. It operates totally outside traditional banking. That makes it incredibly dynamic, sure, but it also makes it highly susceptible to sudden, dramatic price shifts.
Section 2. Unpacking volatility clusters. Let's look at how those structural differences feed into the core behavior that dictates risk in both of these markets, which is volatility. Okay, so there is a crucial concept you need to grasp here, and it's called volatility clustering. In academic finance, it's a very well-known rule that market chaos essentially breeds more market chaos. Significant swings tend to lump together. So if you see a massive price swing today, you are highly likely to see another massive price swing tomorrow, rather than things just immediately calming down. Basically, big losses cluster with big losses, and big gains cluster with big gains. It's like a chain reaction.
To actually measure this phenomenon, researchers use a really interesting mathematical indicator called the Hurst exponent. When high volatility clusters start emerging in a market, the Hurst exponent shows a spike in what researchers call self-similarity. Basically, it's mathematical proof that a series of prices is heavily trending based on its own recent chaotic behavior. Section 3. Predicting market chaos. So, this brings up a huge question. If we know that chaos clusters together, can analysts use complex models to actually forecast these periods of instability before they completely wipe out a portfolio?
Well, enter the E-Garch model. This is an asymmetric conditional volatility model that researchers use to capture something called the leverage effect. Now, what does that mean in plain English? It means that a piece of bad news or a negative shock to the market actually creates a much larger spike in volatility than a piece of good news of the exact same size. It's human nature, right? The market reacts way more aggressively to fear and panic than it does to optimism.
And modern science is actually taking this a step further right now, using artificial neural networks. Unlike your traditional forecasting models, these neural networks can model incredibly complex, nonlinear relationships. They use a process called backpropagation. Basically, the network iteratively learns from its own mathematical mistakes, and these models are now successfully being used to predict market volatility up to 5 days in advance. That is a massive early warning system for traders.
Section 4. The power of leverage. Let's pivot away from the predictive science of volatility for a second and talk about the practical tool that traders use to interact with it: financial leverage.
Think of it literally like a lever in physics. When you use leverage in trading, you are essentially borrowing funds from your broker to massively increase your buying power. You put down a small amount of your own money, which is called margin, basically a security deposit, and that allows you to control a much, much larger asset position.
But, as you can imagine, that lever absolutely swings both ways. The pros are super enticing, right? You can maximize your profits, you can access markets you normally couldn't afford, and you can diversify your capital. However, the cons are severe. Leverage amplifies your losses exactly as much as it amplifies your gains. It opens the door to margin calls, and it really feeds into the psychological temptation to overtrade. Section 5. Leverage in two markets. So what exactly happens when we combine this powerful amplifying tool with the two wildly different markets we talked about earlier?
When we compare them side by side, it's the structural differences that really define your risk. Forex is strictly regulated. In the US, leverage is capped at limits like 50 to 1. Crypto exchanges, though, they might offer massive ratios with extremely loose oversight. Plus, Forex has relatively stable volatility, while crypto's volatility is notoriously high. But here's the absolute biggest difference: the risk mechanism. Because crypto trades 24/7 with highly variable liquidity, if you dip below your margin requirement, you don't just get a polite margin call warning like you would in Forex. In crypto, it often triggers an instant automatic liquidation of your entire position. Game over.
Section 6. Managing your trading risk. All right, with all this academic data and market comparison floating around, how do we actually synthesize this into practical ways to protect your capital?
Here are the absolutely crucial steps you need to take away from this explainer. First, educate yourself and honestly assess your own risk tolerance before you even think about borrowing a broker's money. Start small. Keep your emotions in check. Remember that E-Jarge model we talked about? It literally proves that human panic drives the biggest market swings. And perhaps most importantly, use stop-loss orders. Remember those unpredictable volatility clusters? A stop-loss order is your built-in mechanical defense against a sudden clustering market shock that could otherwise completely wipe out a leveraged account.
I want to leave you with a provocative question to chew on. As we've seen today, the markets are incredibly complex beasts. They are driven by mathematical clusters of chaos, and they're amplified by the heavy machinery of financial leverage. So ask yourself, is your approach to the market actually built on a firm understanding of this science, or are you just relying on blind leverage and hoping for the best? Thank you so much for joining me for this explainer, and keep learning.